Welcome everyone to our July webinar, and this is now Integris Wealth Strategies, the new company name. And for those who don't recognize me, I haven't changed. I'm still David Balin. And with me today is Justin Rice, who is going to do a presentation, which really I wish every one of our clients would have the opportunity to see because it's fascinating in what he's going to share with us. Today's topic is what your tax return is trying to tell you. And no, the answer is not send money to the government. Well, that might be part of the answer, but
Could be
hopefully
one
it's
answer.
saying, yeah, hopefully the answer is the government's going to send you money. But beyond that bottom line, as they like to say, we're going to learn a little bit about what you can learn from your tax return. And this presentation, Justin actually presented about 2 weeks ago to the New Jersey Society of CPAs at their annual convention. So Justin was able to tell CPAs what you can learn from a tax return. And the reviews that I've heard had the audience attention throughout. Uh, Before I turn over to Justin, let me give him a little bit more of a formal introduction. Justin is a tax planning certified professional, TPCP, having completed the final portion of that training last month. So he is the newest member of that organization. He is also a certified financial planner, a certified student loan professional, and he holds his certificate in blockchain and digital assets. So in his free time, beyond trying to get more designations, Justin serves as a father of three, which I hold him in complete envy in that he was able to complete all these designations while being quite busy at home. Um, Justin, I welcome you as our speaker today and I look forward to hear what you have to share with us.
All right, thank you so much for that, David. And yes, and also in the free time, I am an avid Croatian footballer, also USA football fan as well. So go Team USA tonight, go Croatia tomorrow. Should be an exciting month for soccer fans as we culminate at the final game in MetLife on the 19th. Still debating if I can get tickets to that at maybe 10,000 a pop. So we'll see. I'll need to get a bigger tax refund. But I appreciate the intro, David, because so many of us take that approach with the tax return. It's like, well, just tell me what the bottom line is. Do I owe money? Do I get money? Do I get money? What do I have to do? And then they take it and they just file it away. And many are missing out, even accountants themselves, which is why I gave the presentation on what the tax return is actually trying to tell you. Because if you only look at it as a report card, you're not utilizing the full value of that. And so the tax return is very, very essential. And when we work with our clients, we collect the tax return. And initially, when we started doing that several years ago, the clients were like, well, what does that have to do with anything? It doesn't have to do with my investments. It doesn't have to do with my planning. Yes, it definitely does. Number one, what it has to do with your planning is that we want to make sure that everything that we did last year is correctly reported this year. So that's number one that we look at in the plan. So almost as a report card. And yes, we've found errors on tax returns before. We found missing qualified charitable distributions. We've found missing QBI deductions when that first came out and wasn't fully integrated with softwares yet. And so returning it, number one, just checking to make sure any planning that we did is accurately reported. But then number two is looking at it as a diagnostic. Was last year. This is your, and if we think about it from the feeling of a physician, when they get your blood work, when they do an MRI test, they get the results. They don't just say, oh, that's great, let's file it away. They look at it, they interpret it, and they say, well, what can we do to make the next result even better? Because right now, there's nothing that you can do for a 2025 tax year. Well, practically nothing, especially if you filed your return, nothing you can do. If you're on extension, you're a business owner, maybe we can sneak in some type of qualified plan, but for the most part, 2025 planning is over. So now what we're focusing on from a tax planning perspective is 2026 and what we can do to actually change the result when you go bring your stuff to your accountant, your CPA, your EA next March, April, whenever you file. So that's the reframe that I want to go from that bottom line to what can we do in the future? Because tax preparation is backwards looking. It documents the history, whereas what we're looking to do is change outcomes in the future. And you can't do that after the year is over. And what I would also talk as well for those in the audience is tax preparation is basically a commodity at this point in time. And tax preparation itself shouldn't cost that much. And some softwares and AI, I'm sure now are going to be doing tax returns for lower and lower costs as that continues to improve. I don't think we're at the point yet where people fully trust AI to completely do their tax return, but you better believe it because I'm having these conversations with accountants as they're looking to leverage AI for that data entry compliance and to be able to continue to um, get the results and get the filings. But that should drive the price down, and that's good because that is a true cost to make sure you meet the compliance. Tax planning is where the true value lives because that's where you can actually pull various levers to change your outcome into the future. And so if we're changing that and reframing that tax return, that paradigm to a diagnostic report, there's several different zones that we want to look at. And we're not going to be able to dissect a full tax return today, but this is just a general 30,000-foot overview of the themes that we would look at. So number one, we're going to look at the investments. And it's like investments, they're not reported on the tax return. Well, they kind of are. Anytime you realize a gain, that's going to be reported. Anytime you get a dividend, that's going to be reported. Anytime interest gets paid out, that's going to be reported. And those numbers, even historically, mean something. And we can look at those numbers to say, are they where they should be? And we're going to dive into that section a little bit more deeply. Then you have the retirement zone. If you're doing backdoor Roth IRAs or IRA distributions, or you're looking at different taxation of how your retirement works, you want to be able to see that. The charitable zone, a lot of people don't fully recognize how charitable deductions work from a tax perspective, and even more so don't realize now because they were just changed, new effective for 2026. And so we want to make sure to briefly touch on that and those changes. And then finally, if you have a business or rental real estate, that unlocks additional schedules, which has even more data on that. And just to make sure that you have proper income flow, entity selection, all of those different things. And that's something that's probably out of the scope for today. What we're really going to focus in on is the investment zone, number one, the retirement zone, looking at some ways to reduce your taxation within retirement, and then the charities as well. So those are kind of the three overarching topics that we're going to dive into today. So I said on the return, it reports your investments. And so it's not going to report your whole portfolio, your holdings, your allocation. That's going to be on the investment reports. But what it does report is the taxation that comes from your investments. And that's a real cost that you don't necessarily see within your investment report. And there are three main lines that you want to take a look at when you're looking at what I would call a portfolio drag or tax drag, because you have the returns that you receive. But then if you have to pay a lot of money to the IRS, those returns weren't actually realized. It was actually lower, which you can see in that orange line. Your after-tax returns are lower, and try to minimize that drag as much as possible. But in order to minimize it, first you have to recognize it, that it's happening, and then look to see where you can eliminate it from. And so the three lines on the tax return, number one line that you want to look at is interest income. Now, this most likely is going to be coming from your bank accounts. And the kind of diagnosis warning sign there is that if you have no interest, what that means is you potentially didn't report something, or you have all of your cash in checking accounts earning no interest, which is also probably not ideal. So you want to have some interest on that line. And so if you have nothing, typically that means you want to have your savings moved into a high yield savings account So you actually can earn some interest on that money rather than just having it sit stagnant. Now, on the flip side, if that interest line is way high, that means you probably have too much in cash, and it's cash in general is inefficient as an asset. Meaning, number one, yes, you can get okay rates right now in the 3 to 4% range in most high yield savings accounts. And so that's what you want for your emergency fund and very short-term savings. But then once you accumulate beyond that, uh, you're going to lose out on that account to inflation, and you're going to be paying ordinary income taxes on all of the interest that you're accumulating there. And so that is very inefficient to hold for the long term. And so that's line is what I'm telling you. You want that Goldilocks position in the interest line, not too low, not too high, but just right. The second line in the tax return that you look at from a portfolio drag perspective would be let's go with the dividend line, because the dividend line, actually, if you look at it, has two numbers on it. You have what's reported as your overall dividends, and then more specifically, you have what qualifies as a qualified dividend. Now, without getting too technical, what you want, because it has a lower tax impact, is qualified dividends. So if those numbers are equal, meaning your total dividends equals your qualified dividends, that is, you're doing a great job, because that means all of your dividends that got paid out from your uh, stocks, your positions, qualify for the lower tax treatment, which is capital gains treatment, versus ordinary income treatment, which is going to be at a higher rate. Now, most of the time, you're not going to be able to get 100% in qualified dividends. Sometimes you can, but there's various reasons why you're not. So it's not a red flag if only 80% or even 70% are qualified dividends. But once you start to go below that 50% threshold, so if more than 50% of your dividends are not qualified, that's a potential yellow light to say, let's take a look at the portfolio. Where are these dividends coming from that are not achieving qualified status, to see if some adjustments should be made there. And then the final line that I would look at in the portfolio or in the portfolio tax drag section of the tax return would be the capital gains and losses. And so on your tax return, if you're consistently reporting lots and lots of gains, that's probably leading to much more tax drag. And so you want to manage your portfolio in a way where you're looking to not just realize gains for gain's sake and try to hold assets, because as they accumulate, you get a kind of built-in tax deferral there until you sell. On the flip side, markets are volatile. So you have some things that will move up, some things that will move down, and you will have an opportunity at some point in time, potentially, to harvest what we would call tax losses, meaning that you would sell a position that you had lost money on. Typically, you don't just sell it and then do nothing. You'll typically buy something. You can't buy the exact same position, or else the loss would get wiped out. But you can buy something similar and still stay invested, but harvest that loss for tax purposes. And then if the losses outweigh the gains, you can report a loss on your tax return against your ordinary income up to a maximum of $3,000. And so an efficient tax loss harvested portfolio should consistently see negative $3,000 in that box to continue to take money off of your ordinary income year over year. Now, you also have to be careful, especially for those of us that are watching from New Jersey, and you have to pay attention to your state-specific rules as well. But for example, in New Jersey, it doesn't work that way. So your losses that you get, you have to take them against your gains, and there's no carry forward of those losses either. So I don't expect you to fully grasp and understand that, but I made the point just so you know there's the federal, which is what we're really focusing in on, but there's also state-specific rules that you want to pay attention to, so you're not doing something federally and then hurting yourself at the state level and paying more in taxes than you otherwise need to. So those are the key insights. So that income that you receive, the gains that you get, the interest that you get, it's not necessarily automatically bad. because if you're getting interest, you're getting dividends, you're having gains, that means you're making money somehow. So that's probably a good news. But the question is if it's unnecessarily getting transitioned to you as taxable, when instead it could be tax deferred somehow, that's what you want to be able to focus on. And one of the main ways that we look to do this is via asset location. So many are familiar with asset allocation, meaning, which investments do I own? Apple, Nvidia, Tesla, etc. US stocks versus international stocks, large companies versus small companies, stocks versus bonds. Like that's the asset allocation. The asset location is where we hold those investments because where you hold them can have an effect on the tax efficiency of them. And in general, there's three main accounts that are listed on the left. A taxable account, that's your brokerage account, bank account, etc. A tax deferred account, that would be your traditional IRA, 401k, SEP, simple IRAs, um, you know, uh, that tax deferral, but you owe taxes eventually on that. And then the tax-free bucket, which are things like, a Roth IRA or an HSA, as an example. And so when you look at where those investments are, if you hold a very tax inefficient asset, you want to preferentially hold that in a tax deferred or tax free account. Meaning, if that asset is going to be throwing off a lot of gains that are going to be paying taxes, you would want to shelter those gains that it is going to be throwing off in a tax deferred account. And so we're not talking about changing your holdings. We're just talking about instead of holding it in this account, you don't hold any in that account, you hold it all in this account. Because what we see most often when we get and review portfolios is, let's say you have all three of these different accounts. Some people don't have, some people just have two accounts or even one account. And so that's a separate conversation. But let's say they do have all three of these accounts. They've got a joint brokerage account, they've got an IRA, and they have a Roth account as well. And then let's just say, for argument's sake, they've got a 60-40 just generic portfolio, 60% stocks, 40% bonds. Well, we would see in the taxable account 60-40, in the IRA 60-40, in the Roth IRA 60-40. So they'd hold the same portfolio in all three accounts. But that's going to be very inefficient because let's say for bonds, as an example, the 40% of that, they're going to be paying off dividends and interest that's going to be fully taxable. So it may be more efficient to hold those bonds in, let's say, a traditional IRA where you get that tax deferred nature, and then move some of the stocks that are US large company stocks, growth stocks that aren't paying a lot of dividends, and move those out into the taxable account. So you might have 60-40 when you look at all three of your accounts together. But if you looked at one individual account, your taxable brokerage might be, 80, 90, or 100% stocks. Your tax deferred account might be, 60% bonds and 40% stocks. And then your Roth IRA might be invested super aggressive on its own because that's only invested in international small companies and emerging market stocks. Because there you want to get as high of, growth as possible because all of that money is tax-free into the future. So the key takeaway here from this slide is that your portfolio should not only be diversified by the asset classes that you're invested in, that's a key part of diversification, but it also should be coordinated with the tax location and the taxable nature of the accounts that you're holding. Now, diagnosis number 2, we did a deep dive into the location, the interest, dividends, capital gains. But what about is maybe paying too little in taxes is not a good thing either. Because if you look at your traditional IRA as an example, that can be a ticking time bomb for taxation into the future in many different ways. And so maybe it would make sense to look to pay a little bit extra in taxes now so that we can save money over the lifetime of the tax of your lifetime tax burden. So the planning isn't always, so for 2026, it isn't always saying how can we pay the lowest tax possible in this year. The question is, how do we pay the least amount in taxes over the next 10, 20, 30 years, or even multiple generations as well, which also comes into this. Because just to, re-put on this, these different tax buckets, that taxable, tax deferred, and tax free that I was just talking about, each of them have some hidden risks, and we're going to focus right in on that tax deferred bucket, that traditional IRA bucket, looking at number one, mandatory required minimum distributions. So when you reach age 73 or 75, depending on the year you were born, you are required to start taking money out of the IRA, which is going to force taxation on you. Then you have to pay attention to Medicare income related monthly adjustment amount, IRMA, surcharges as well. So as your income increases, you have to pay that. Then you have things like what's referred to as the widow's penalty, because if you're married filing jointly, you have expanded tax brackets where you're able to work your way through. When one of you passes away, now you go from filing jointly to filing single. Those tax brackets compress, so you're going to reach the higher percentages much faster filing single than jointly. And if you have IRA monies, it's all going to be combined anyway, and those RMDs are still going to continue. And so you can get forced into much higher taxation there, even if you didn't want to. And then the final piece of that is the new inherited rules. So when you leave your IRA to the next generation, before they could just take their required minimum distributions over their lifetime, they can't do that anymore in most scenarios. Now they're stuck to what's known as the 10-year rule. So they've got 10 years in order to empty the account. And, if it's $1 million IRA, they just smooth it out. That's $100,000 a year, roughly, not even including investment growth, that they're going to have to realize on top of their income. And so if they're inheriting this in their highest earning income years, that could layer on at a very high tax bracket, a tax bracket much higher than you, as the taxpayer while you were alive, would have ever paid. And so that's what we want to be thinking about. And one of the ways, the key ways that we do this is something called a Roth conversion. And this is something you have to be careful with because there's a lot of unintended consequences of realizing more income. And it's not just about the tax bracket. I want to make that very clear, because if you're only looking at a tax bracket, you are probably going to dramatically underestimate the amount of tax or cost that you're going to pay from doing a conversion. And I'll just give you some quick examples of those landmines. Number one is Social Security taxation. And we had this recently, just this year, we collected a tax return, and they were like, yeah, when the accountant did this, they said we should have done a Roth conversion last year because we're in the 12% bracket. And I'm like, oof, crap. Did we miss that? Maybe we did. I could have sworn I analyzed it. And then so I took a look at the tax return. I did the analysis, and sure enough, yes, they were in the 12% bracket. But what they were also in was a Social Security phase into taxation. And so how Social Security taxation works is that you can have actually 0% of your Social Security taxed. And as you add in more income, more of that Social Security gets taxed up to 50%, and then 85% is the maximum. And so what we see a lot of times for, those that are in that lower income threshold where a lot of their Social Security is coming in, or Social Security is most of their income, we see in this kind of, it's called the torpedo event, where you take a $1 of a ordinary income realization, and then it pulls 85 cents of its Social Security friends into taxation as well. So your 12% bracket, yes, you're taxed 12% on that $1, but now you're taxed 12% on this new 85 cents. And so in reality, that $1 costs you a lot more than 12%. And so you want to pay attention to that. It could still be worthwhile to realize that if you're going to have taxation lower or higher, even higher in the future, but those are some of the things that you want to pay attention to. And another thing you want to pay attention to are things that we would call cliffs, meaning that most of the tax return, as you increase, in a bracket, let's say you go from the 12% to the 22%, you go $1 over, well, only that extra dollar is taxed at the 22% rate. Whereas a cliff You go $1 over, and now you have a bunch more taxes than on just that $1. One example of this is the Medicare IRMA surcharge that we were just talking about. Those are cliffs. You go $1 over the threshold, and now, each you and your spouse are paying, an extra $1,000+ per year in your Medicare costs because of that one extra dollar. And so that tax cost and that $1 is like 200,000% if you only went over by that $1. And so you want to be very, very cautious of cliffs and then cognizant of, the moving up in the brackets. The final diagnosis check I want to talk about is charity. And this is a great time to be talking about it because first off, we want to talk charity because of generosity, not because of a tax benefit. But if you're going to be charitable, you might as well do it in a way that you're going to maximize your tax benefits so that you can give more. And rather than giving a gift to the government, maybe some of you, the government is your favorite charity, but I don't think so. And so rather than being generous to the government, do your giving in a way to actually benefit the charity even further. And so that's where we take a look at. So you're never going to be in a charitable situation getting more back for your dollars because of your charity. But we want to do it in a way that you maximize the tax benefits because a lot of people, historically speaking, over the last several years, think that they're getting benefits, tax benefits for their charitable contributions, and they're not. Because over the last couple of years, what happened is that you really only got a charitable benefit if you itemized your deductions. And so if you didn't itemize, you didn't get any benefit for your charity. And so you just collected it with your tax stuff. Say, I gave some here, gave some there. You gave it to your accountant. They said, okay, here's the number. You get back 2,000. You're like, yay, I'm getting a benefit. When you actually look at the tax return, you see that you took the standard deduction. Well, guess what? That charitable benefit that you gave, historically speaking, now we're not talking about 2026 yet, and 2025, you didn't get a benefit for that if you only took the standard deduction. And so that's what we're talking about here. So first, we always start with that giving intent. And then there's a couple different ways that you want to look at when you're gifting, because there's a lot of different ways to give. Most people just think, well, take a credit card, I'll write a check, I'll do it that way. That's probably more often than not the least efficient way to give. And I'm going to start from the right to the left here. So the first way is this is only available to you if you're over age 70 and a half. Once you reach that age, you then have the ability to take distributions from your IRA and gift them directly to the charity. So you're not taking possession of it and then gifting it. You're taking a direct, what's called a qualified charitable distribution directly from your IRA to the qualifying charity. What does this do? It basically wipes it out so it really doesn't even appear on the tax return. It does appear on the tax return, but it's not taxed. So let's say you do a $10,000 QCD. You do it directly from the IRA. Now remember, this is all pre-tax money. So if you took that money, that $10,000 you took out is going to be fully taxable to you as ordinary income. When you gift it to the charity is not going to pay any taxes on that because they're a 501c3. And your tax form is going to say $10,000 IRA distribution. There's a little box that says QCD. That gets checked. And then all the way over to the right, the taxable amount is going to be zero, assuming that the full amount was a qualified charitable distribution. So that zero of that is taxable, and so it doesn't affect anything. Now, that may not sound like a huge benefit, but imagine now if when you reach required minimum distribution age, and now you're required to take that 10,000 out, whereas 70 and a half used to be the required minimum distribution age. It's not anymore. Now it's 73, 75, but the qualified charitable distribution is still 70 and a half, a little bit confusing because there's the disconnect there. But once you reach RMD age, let's say that 10,000 was going to be forced out to you anyway. Well, now you have to take that income. But what they say instead, the qualified charitable distribution, assuming that you do it first, counts towards the required minimum distribution. And so rather than realizing that 10,000 and then doing other giving, you can gift via the qualified charitable distribution and then not have it reported as taxable on your tax return. The next over to the right in the middle is looking at either a higher income year Or potentially you have, um, a year where you want to itemize your deductions, as an example, and you want to gift more in that year so that you itemize and then look to take the standard into the future. Well, that's a really good idea for a donor advised fund. And with a donor advised fund, you don't actually have to choose which charity gets the money yet. That choice is still pending, and you make the gifts directly from the donor advised fund. But what this essentially allows you to do is bunch multiple years of deductions into one year. So let's just say you were going to give $5,000 a year over the next 3 years. Well, instead of doing that, let's gift 15,000 this year, so that could potentially bump us up into the itemized deductions and actually get a benefit for that from a tax perspective, and then not give anything else. But from the charity's perspective, you can then gift directly from the donor advised fund 5,000, 5,000, 5,000. So everything stays the same from the charity's perspective. You're just bunching those deductions into one year so that you can get over the hump for itemization. The third and final way is that if you're holding stock, because like I said, most people, assume for gifting that they're just going to give cash. But one benefit is if you've had stock that's been accumulating in your portfolio, to actually gift the stock. Now, why would you want to do that? Well, number one, assuming you've held it for more than a year, you get the deduction based on the market value of the stock when you gift it. So let's say you bought a stock A at $10 a share, and now it's worth $100, and you want to gift that one share of $100. So now you gift that one share, you get $100 off your tax return. But what about the $90 of growth there? If you were to first sell that and then gift the money, you would have to pay taxes on that $90 of capital gain. But by gifting the shares, you get the full charitable deduction for the market value, and then the gain gets completely wiped away. You don't have to realize the gain. The charity doesn't have to realize the gain either. So capital gains gets avoided entirely in that situation, while the charity still receives the full value and you get the full market value of the deduction. And you can combine these things, by the way, so you can gift appreciated securities into a donor advised fund, et cetera, to help with timing of that. Some other things that I just wanted to briefly touch on. You want to pay attention to, again, income spikes. If you're owning a business and you have business income that is starting to accumulate, there's some different ways that you want to take a look at your business to see if it makes sense to potentially shift over to a different entity selection, like an S corp, as an example. If you want to institute a retirement plan through your business. So a lot of small business owners don't realize that since they're the business, they're not limited to just an IRA. They can actually, through their business income, do a 401k for themselves or some other type of business retirement plans. And so that's something you should definitely consider. You also want to take a look at if you're paying any penalties, under withholding penalties, because most people from a W-2 perspective, if you're just an employee, you don't have to worry about that as much because the withholding comes automatically through your paychecks. But if you're a business owner and you have, volatile income, and you get some more in one month, some less in the other month, if you're not paying estimated taxes along the way, you could have some under withholding penalties associated with it, which is reported on the tax return. So that's an easily avoidable penalty, and so you want to make sure to eliminate that if you have that. Another one, if you don't have any money in Roth, you probably want to fix that. There's even ways for most people that you can get money in Roth, even if you are over the various income limits, because there's income limits to be able to contribute directly into a Roth. And so you want to be able to have some of those tax-free assets and get that tax diversification and flexibility if you can. And then finally, looking at those capital loss carryforwards, as I was mentioning before, you've got a loss. Make sure you're utilizing it to the maximum. If you could potentially, look to diversify from a position. If you're, holding a lot in concentration, you just hit micron hot over the last year, and now you have some carried forward losses. Maybe it makes sense to harvest some of those gains while it's still in favor, and use the losses that you've been carrying forward to offset that. So you can diversify and not pay a huge tax bill. So a lot of the time when we're looking at it, not every like blood marker on a blood result means you need aggressive treatment, but it may signal that it's time to make some changes. And this isn't necessarily, or it's definitely not, about one particular strategy or even one particular expert, because everybody in your financial life, including your advisor, your accountant, your attorney, should be working from that same diagnostic report to be able to create a holistic plan for you. So if your primary care doctor wasn't talking to your cardiologist, that's not going to be a good situation for you medically. Whereas if your advisor is not talking to the CPA or accountant or looking at the tax return and working with that, you're going to have inefficiencies within your plan, or worse, you're going to be actively working against each other. And so one just a generic example of this, because it's not, again, not about one strategy or one result, but let's say we look at that Roth conversion strategy to alleviate some of that future tax compression. But at the same time, that's obviously going to generate a tax bill today. Well, let's look to offset that. So you were already giving anyway. Let's shift the way you give. Let's do a donor advised fund so we can get a higher itemized deduction this year to offset some of that taxes. And by the way, we'll use a donor advised fund to be able to do that, taking some of your highly appreciated assets into that. So that's one example of a holistic treatment, combining some of these different strategies to get the best result possible, so you're not leaving wealth on the table. I'm going to be able to take some questions in a second, but the final here is you get the tax return, you identify the findings. What is the raw data actually telling us? Number one, interpret the diagnostics. What does that mean for your life? Now, we're not going to minimize tax just to minimize tax sake. We're also not going to do things only for the tax benefits of it. We never want to let the tax tail wag the financial dog, is a popular saying, but it's very, very true, because those that do things only for the tax benefits either end up, usually would end up worse off, not better off. Then we want to investigate. Is this a chronic thing where we're going to have to work on it, or is it just a temporary symptom? Build the overall plan, and then continue to monitor. So this isn't just we do this in 2026 and it's going to be great forever and always. You want to do this every year, just like you go to your primary doctor every year, just to check your blood work and make sure everything is looking good with your cholesterol and your blood pressure, to make sure everything is working as planned. David, do we have any questions that have popped up in the Q&A, or anything that you want to make sure that we talk about?
Well, let's first announce that if you do have questions, please go into the Q&A function and go ahead and input your questions there, and we will try to address them live while we have Justin available to answer. And I certainly do want to thank Justin for what was a really informative session. I think we now understand the idea that there is information in our tax returns beyond the bottom line. So the first comment we have is coming to us, and it just says this presentation was very comprehensive. Will this presentation be made available to participants?
Yes. So we will have this available on our YouTube channel. Give us usually about a week where it would be able to be on our YouTube channel. And you being here, you will be the first to know about it, because you will get an email as soon as that recording is available so you can review. The second thing that I would say is, rather than trying to make sure to pick up on all of the different things that we talked about, number one, if you're a client, let's just have the conversation in a client meeting. If you're not a client already, what we're offering today for being here or being able to watch this as a recording in YouTube is a complimentary tax return diagnostic review. And so I just put the link for that in the chat to fill out the form to request that. And then we would be in touch on how to securely get us the information to be able to give you that report. And then if you're watching this on the YouTube, down in the description below will be that link where you can fill it out and apply for the tax return diagnostic review.
Thank you, Justin. Now we have a question going back to the section we were talking about asset location. You have a question here about somebody who has money in their 401k plan at work. They have a brokerage account. They have their bank account. How do you do asset location amongst all the different locations that you might hold these?
That you have to manage it. So that's the way. So either you are going to do that or you hire an investment professional to be able to do that. Now, if it's solely bank interest, there's not so much you can do about that if it's, very, your emergency fund or your short-term savings that you need to buy your next car, like that's just going to generate interest. So that's kind of on your own or in association with your advisor just to continue to monitor that. But when it comes to the actual portfolio, it pays to have everything in one place. Now, sometimes you can't do that. For example, if you have your 401k at your current employer where you're contributing to, and then you have an IRA and a Roth and a brokerage account on the side. But in those situations, we'll typically have to just do it a little bit more manually. We'll change, where you're contributing to within the 401k and then, adjust accordingly in your other accounts outside so that you maintain that. So it's a little bit more of a manual process, but that's how we manage it.
Thank you. That's a great point because I know we see times where people lose track. You're talking about appreciated assets, and sometimes they lose track of the fact that different family members have different tax brackets. So particularly with adult children. So while you were giving the example of gifting money to a charity, gifting money to an adult child might be a way to avoid or reduce the tax burden as well.
Yeah, yeah. And just along on that line, one thing that I didn't mention is a beneficiary review on each of these accounts. So the taxable account will get a step up in tax basis, typically at death, meaning that when your inheritors sell that, they're not going to realize the gain. It's going to be wiped out. The IRA money, the traditional IRA money, they've got that 10-year clock, which I did talk about, and it's all ordinary income. And then Roth IRA money is all tax-free. And so if you've got two children, a teacher and an entrepreneur business owner that's pulling in $1 million a year, well, the $1 million a year earner is going to be much more beneficial rather than leaving 50, 50, 50, 50, 50, 50 in each of the accounts. You leave the more tax-free sheltered accounts and you can, net of taxes, leave less money to the wealthier one because you're leaving it via Roth because that's going to be all tax-free to them, where the teacher that's in a lower income, you leave the full traditional IRA to them because they're not going to owe as much taxes on that when they pull and take the money out. So that the who gets what conversation is also important with these three different registrations as well.
Great point. We've generated a number of questions, which is great. So the next question we have is, are treasury bonds, which do generate interest, a good idea for retirement planning besides the use of an IRA and a Roth IRA?
Not going to make a comment on a specific type of asset and whether it would be a good idea for retirement planning. Are treasury bonds a good part of an overall diversified portfolio? Yes. And then the question is, if we're going to hold them, how do we hold them and where do we hold them? And that's a general conversation. I'm not trying to dodge the question, but it's much more than are treasury bonds a good idea for retirement? Sure, but what does that mean? And how much of them do you hold, and how long of a duration do you hold, and where do you hold those? And just to directly with the treasury, or do you hold them within an IRA or Roth IRA, as you said?
And it goes to the point you were making earlier. Treasury bonds, as the questioner asked, does generate interest. Well, retirees pay taxes too. So do we want to pay taxes on that interest? What bracket are we in? Is there a better place to hold them? All that kind of thing comes into play. Yep.
Yeah. Yeah.
Next question we have. My mother is 94 and we're running out of cash to cover her medical costs. Her remaining assets or properties and investments. Are there any tax breaks or tax strategies to avoid the capital gains if that money is needed for medical care?
So, this will depend on the exact situation. But in general, medical costs are qualifying as an itemized deduction on the tax return, assuming that they exceed 7.5% of the adjusted gross income. And so you just have to be careful because as you are realizing more income, you're going to kind of raise that bar and that threshold. But if she's got a lot of medical costs, then it may make sense to realize those gains because she's going to have the deduction on this Schedule A to be able to take that as an itemized deduction. So the tax break is the medical costs themselves are deductible to the extent that they exceed 7.5% of her adjusted gross income. And then the other thing I would say in this specific situation is that I was just alluding to in the who gets what conversation, to the extent that you can hold the assets versus just selling them. Obviously, if you need the cash, you have to sell it to generate the cash. But I wouldn't look to sell it just to sell it because those assets, especially if they're very highly appreciated, will receive a step up in basis at death. And so if 94 years old and medical costs are high, depending on the life expectancy, you would receive a step up. So you wouldn't want to realize a gain only to have your mother unfortunately pass away the next day, because those gains would have been wiped out if you just held them to death.
Another great point. You have to look at the holistic situation before we can answer a question.
Yeah.
I mean, there's one question or one comment from me that I'd like you to comment on. On an earlier slide, you were talking about one of the red flags is having zero assets in a Roth IRA or Roth 401k, and that we sometimes see that with people who have made pretty high incomes early in their careers, or perhaps have neglected their planning. But let's use it as a high income. One of the changes in the tax law for 2026 is, of course, people who are making catch-up contributions to 401k plans now have to contribute those catch-up contributions into the Roth side, not into the traditional side. So from a planning perspective, some of that could be self-correcting, even if you didn't want it to be. And I just want to get your comment about how you're factoring that into the planning work that you're doing in 2026.
I mean, yeah. So that rule leads even more to a red flag of if you don't have any Roth money, because that means you probably have potential to save more in a tax preferential way, and you're not doing it if you're a high income earner. So not only are the government is basically forcing you, and I don't know if that's I prefer necessarily a good thing. It's actually probably a bad thing because if you're at the highest bracket that you'll be, and we could potentially, you get down to a lower bracket, I'd want to have a deduction for that. But to the extent that they're going to be able to give it to you in the form of Roth, that's the only way you're going to have access to it. Then yeah, let's take advantage of that. Still max out the traditional side of it to get the maximum tax deduction today that you can get, but then let's get that Roth benefit as well for any monies that don't qualify.
All right, Justin, thank you very much. We have a few more questions, but I think we're going to call it quits here because of time constraints. I know some of the people have other things to do than interpret their tax return today. But I would say this, just as granted an interested observer, but an observer, what's on the screen right now, schedule a tax return diagnostic review. I don't know why anybody would pass up on that opportunity. If your tax preparer has not done this for you, if your financial advisor has not done this for you, you need to do this because at the very least, you will find it educational. But there's probably opportunities that can improve your return. One of the things that I often say to clients is, would you rather have a 10% rate of return or an 8% rate of return? And it seems pretty obvious you would want to say 10%, but the follow-up is, what's the tax liability on the 10%? What's the tax liability on the 8%? If the 8% is tax-free and the 10% is subject to a 37% tax, I think I'd rather have the 8% tax-free. So go ahead, Justin, I saw up in the chat, he sent that form to complete. Please go ahead and complete that. Please reach out to us with any questions that you might have that maybe we'll cover today, or perhaps we're a little bit more specific than we could do in the general nature of the presentation. Justin, I thank you for your time and your knowledge today, sharing your knowledge with us. Any final thoughts?
No, thank you for coming out today. We're happy to do that tax return diagnostic review for you just to identify some opportunities. And then looking forward to seeing you next month at our normal monthly webinar series on the first Wednesday of the month. We're going to continue that under the Integris brand.
Super. Yeah, and that next webinar will be on August 5th at noontime. And an important reminder, if you found value in today's presentation, recognize it's only one of the many that we've done over the years. You can go to our YouTube channel, and there's the entire library, which I think we've now hit 50. So there's many topics. And if you don't see your topic there, let us know, because it could be the topic in one of the coming months of 2026. We hope you've enjoyed your time with us today. We hope you've made taxes a little bit more interesting and particularly more profitable to you. And we look forward to seeing you next month.